Thank you very much. Can everybody hear me? Yes. Okay. Well, thanks a lot for not just having our paper in the program, but for organizing such a great conference. I think, as the last presenter, I should say that. So thank you guys for doing that. So this paper with two former working students, this clicker is going back and forth, Fang and Yang Lu, who are both at HKU, and given the time difference, probably are no longer with us on Zoom. And it's about getting to the core and inflation risks within and across asset classes. And we started working on this paper pre-COVID. So at the time, the inflation risks that people were worrying about, probably that there was going to be too little of it or none at all. And of course, here we are today. And I guess the views have changed a bit. And I think, well, maybe that makes the paper a little bit timely. So I don't need to say anything more about inflation news being important. More kind of generally, we typically have a hard time identifying macroeconomic factors that matter for asset prices, and inflation is one of them. But now, if we think about from the perspective of long-term asset management, right? We might want to know, how can investors protect themselves or hedge against inflation, and at what cost, right? What is the price of risk associated with inflation? Now, conventional wisdom has it that there are real assets, quote unquote, that are good inflation hedges, such as foreign exchange, commodities, real estate, and perhaps stocks, right? Because stocks are supposed to be claims to real cash flows. And as far as the price of inflation risk, we have hard time finding kind of a consistent answer. It's clear that reasonably clear that there is a risk premium in nominal bonds, but in other asset classes, it's hard to see whether there is one. So we're revisiting that conventional wisdom and maybe lack of consistent evidence in this paper by taking a pretty straightforward approach and drilling into the composition of inflation, and in particular by decomposing it the way that the BLS does and the way that the Fed likes to do into the core and non-core, or some people call it crust components, energy and food. And really we're going to focus on energy as a counterpoint to the core as the kind of the two key components, and focus a bit less on food. And we're going to look at 8 asset classes, and we're going to show that all the conventional wisdom is not quite right. In that none of these 8 asset classes provide a sort of consistent hedge against core inflation. And the assets that we typically think of as real, like commodity, for example, hedge against energy inflation reasonably well, but again, not against core. And we argued core is the important component that investors should care about. And in fact, if we look at the price of risk that we estimate, it is indeed that the core inflation that investors do appear to care about, because that's the price of that risk that is consistently negative and reliably so across all of these asset classes, as well as within asset classes. Once we kind of get through this evidence, we will talk about how this result impacts the discussion of the stock-bond correlation that has been changing over time, that we spent some time yesterday in the asset pricing session discussing with the Pietro's discussion in particular of the paper that was presented. And we build a very simple, not New Keynesian style model that qualitatively kind of explains why we see these results. It's not a quantitative model, really, so I will probably spend very little time on it, if at all, in this presentation. I will skip the literature and get directly to the empirics. So if we decompose inflation into its 3 key components, core, energy, and food, we see kind of the important distinction in that. Core is, of course, the most important and largest component, 70% of the basket. But the bulk of the volatility is actually contributed by energy, which is by far the most volatile component, even though it's relatively small as a component of the basket. It's also the one that's least persistent, right? So people kind of focus on the volatility, but it's equally important the fact that almost all of the persistence in headline inflation comes from the core. And energy almost looks like nearly a random walk, meaning unpredictable. So clearly, this decomposition informative to the Fed. The Fed likes to focus on core, not, well, we're going to focus on core CPI, they like core PCE. But the fact that these components behave differently suggests that they may be kind of important to not just the Fed, but to investors in different ways. So what we're going to work with innovations to these inflation series. To extract innovations, we just put all of these series into a VAR together with variables that we know predict expected inflation well, like interest rates, also PD ratio. The graph here shows the time series of the innovation to the headline, core, food, and energy. And I think that's instructive to look at the volatilities of these series over time to understand kind of where the shocks are to headline inflation in particular are coming from. In particular, in the great inflation era in the 70s and the 80s, you can see that it's mostly in the core and food, and very little of it was in the energy. Whereas after after the Volcker era, core inflation has been very, very smooth, as well as kind of declining and low. Whereas the bulk of volatility in the headline inflation has been coming from energy. In particular, when people talk about deflation during the financial crisis and Great Recession, almost all of it is coming from energy. Core never went negative, actually, but the big drop in energy prices here is what drives the big drop in headline inflation over there. So again, this just suggests that these shocks behave differently, and from here on, we're going to kind of work with these shocks separately. In particular, we're going to focus on headline versus core and energy, and we're going to spend less time on food. We're going to look at 8 asset classes that comprise equities, both US and international, bonds, treasuries, agencies and corporates, currency portfolios, and commodity futures and REITs. And we're going to look at each asset class as a portfolio, as well as look at the cross section of test assets within each asset class. So this is, well, one picture, hopefully, that kind of tells this story. These are the inflation betas by asset class, and the purple is the beta on headline inflation with the confidence bands around it, and the blue bars are the basically confidence bands around the beta on core inflation, and the orange ones are energy. And you can see that, of course, all bonds load negatively on headline inflation as well as the core. Energy, actually, we have slightly positive floating for corporate bonds. Equity has kind of insignificantly negative in the full sample beta on headline inflation, but very, very strongly, significantly negative core beta, and pretty positive and pretty, well, barely significant in the full sample, very significant in sub-sum samples, energy inflation beta. What about these so-called real asset classes like currencies, commodities, and REITs, and maybe international stocks? Basically, the picture is the same in that wherever you see a somewhat positive or maybe strongly positive in case of commodities, core, so headline inflation data, it all comes from energy. And core inflation betas are either very strongly negative, like they are for REITs and international stocks, or basically zero, like they are for commodity futures and currencies. Now, what if we were to try to estimate the price of risk? And here, this is kind of the simplest thing that we do in asset pricing to estimate the price of risk. We do Macbeth regressions of returns on inflation betas. Well, if we did that with either just the 8 average portfolios or the entire cross section for headline inflation, you see obviously nothing, right? There's really no no evidence of sort of a risk premium associated with these betas. Instead, if you do this with core inflation and energy inflation, you see a very kind of stark picture that average returns line up very strongly with the combined betas on these two inflations, and really the driving one is the core, although energy does help a little bit. And this is very robust to controlling for a host of other macroeconomic factors that really are not, none of them are priced basically in the presence of core inflation. We can also do this within each asset class. So here we're taking a large cross-section of portfolios within each asset class that I just showed, and basically do these Fang-Macbeth regressions within each asset class. And again, this kind of a striking fact is that the top row here is the risk premium that is estimated within that asset class. And obviously they're not exactly the same, but they're pretty close. They're all roughly at negative 1 percentage point per month, with obviously some standard errors around it. Almost all are strongly statistically significantly different from zero. The only one is commodity futures, very, very volatile as a class with kind of hard to estimate price of risk. But basically, all of these prices of risk come out roughly the same across all of these asset classes. And if you look at the bottom sub panel, the betas on headline inflation, if you estimate them asset class by asset class, they're all over the place. Some of them are negative, some of them are positive, many of them are insignificant. You sort of basically get nothing. And if you look at energy, that you can kind of see why that happens, because there's some asset classes that very strongly load positively on energy. As I said earlier, corporate bonds, to some extent stocks, and of course commodities, whereas others load either negatively or not at all. And again, when you put them together, you get these kind of inconsistent numbers for headline inflation. You can also use this as kind of a standard FAMA point. You can use the Fang-Macbeth cross-sectional regression slopes as returns on effectively beta mimicking portfolios or factor mimicking portfolios, and you can estimate Sharpe ratios in these portfolios. And these are all fairly consistent across asset classes if we use core inflation, but again are all over the place for the other two. Now, so why is that? Why should we expect core inflation in particular to be such a kind of strongly negatively priced source of risk? Well, one kind of popular hypothesis is FAMA's the proxy effect hypothesis, right? The fact that the relationship between stock returns, in particular in inflation, has to do with the fact that inflation is proxy for some other real variables. Kind of high inflation is bad news for the real economy, and that's what shows up in the stock market. And that does, to a large extent, come out to be true. Again, we're using here a long enough sample to detect that negative relation between inflation today and subsequent next quarter or next year GDP consumption or dividend growth. Interestingly, well, so it sort of works for headline. It works even better if you use core inflation, especially for dividends, so corporate payouts. So for consumption of GDP, it looks about the same. But for dividends, you have much stronger predictability of dividend growth with core inflation than with headline inflation. And for energy, you get basically nothing. Again, as it was suggesting that energy, if anything, it sometimes goes the other way. Suggesting again, it's the core inflation that if there's anything related to real conditions, so of course an important observation there is a great inflation, right? The stagflation era, but the relationship holds even in the more recent sample, although of course much less statistically significant since we have a lot less variability in the right-hand side variable there. Another question one may ask, well, is this cash flow news or is it just discount rate news, right? Is it because the Fed raises rates in response to inflation, for example, that tanks stocks and other asset classes, or maybe if inflation rises, inflation risk premium rises, and that also goes down. So if we could do a kind of a standard news decomposition into cash flow news and discount rate news, and we see that for core inflation, it shows up in both cash flow news and discount rate news, and positively for discount rate news and negatively for cash flows. So both basically go in the same direction, because obviously higher discount rates bring down prices just the same way that the lower cash flows do. Interestingly, you hear a lot about the effect of rising rates and rising inflation on tech stocks and growth stocks, that having to do with maybe duration, so suggesting a discount rate effect. If anything, we find the opposite. We find that's the value stocks that are more sensitive to the discount rate effect of core, whereas the growth stocks are more sensitive to the cash flow effect. Energy, there's not much. There's a little bit of a discount rate effect. There's no cash flow effect, interestingly, of energy on these portfolios. Now, another kind of way to think about it is that, well, is all of the effect of inflation on stock prices, in particular, due to, again, the Fed response to what inflation comes out to be. We can do this by looking specifically at the days of inflation announcements. So a narrow window right after the inflation announcement, and we can use Fed fund futures as well as the professional forecasts of inflation to get a kind of the magnitude of inflation surprise. Core inflation surprise seems to move Fed fund futures a lot more strongly and much more reliably, significantly upwards, obviously, than headline, interestingly. And in fact, controlling for core headline, it doesn't matter at all. So it is the core inflation that moves the Fed fund futures, again, not surprisingly, given that we know that the Fed primarily looks at the core. So what about stocks? So stocks negatively react to core as well as headline inflation news, but controlling for headline, core is still quite significant, although it seems like stocks respond to both. And controlling, interestingly, for the Fed fund futures surprise, again, the effect is basically there. So it's not that the stocks only react to inflation because the Fed is expected to react to inflation. Finally, I mentioned that I would get to this, that this time varying exposure of different assets potentially to inflation might tell us something about this puzzle of changing stock bond correlation that we talked about yesterday. So the fact is that a correlation between stock returns and bond returns was positive in certainly the last several decades of the 20th century, and then became negative roughly around the end of the century. You can debate whether that's 1997 or 99, but we made a cutoff at 99, but we don't take a very strong stand on it. So our way of approaching this changing correlation has to do with, again, with decomposition of inflation into core and energy, because again, both, of course, stock returns and bond returns are correlated with inflation, but these correlations have changed over time. In particular, if you look at the betas of stocks and treasury returns on headline inflation, they were both negative in the first part of the sample, but in the second half of the sample, stock returns have a positive beta with headline inflation. So that suggests that perhaps, in fact, there is, at least to some extent, a nominal or inflation-related channel to this changing correlations. And when we do the decomposition into core and energy, we see that changing correlation is only due to the energy component. So core inflation is negatively related to both stock and bond returns in the first part of the sample and in the second part of the sample. Now, again, the second part of the sample is a bit shorter. The inflation volatility is very low, so significance is not particularly great, but actually it's even less significant for bond returns than for stock returns. So I wouldn't make too much out of that. But if you look at energy, which has been much more volatile and a component of inflation, especially in the 21st century, that's where you see this changing correlation or changing beta of energy on, or stocks on energy inflation from being negative in the 20th century effectively to positive in the 21st century. Whereas, again, the bonds, of course, are always negative. So we argue that at least a big chunk, if not all, of the changing correlation between stocks and bonds over time has to do with this changing role of energy. I'm basically out of time. Oh wow. Okay. So this is then what I'm going to do is I'm going to completely skip the model. The model is relatively straightforward, but basically we add to a standard new Keynesian model, we add an energy good that has both the supply and the demand shock. And basically you can trust me at this point that in addition to kind of standard New Keynesian markup shocks, we get all the action that we need. I'm going to very quickly skip through my slides since I apparently have talked much slower than that. Okay, let me get to this point, which is well, okay. Thank you. I will say the following. In these New Keynesian models, core inflation, positive core inflation shocks are contractionary, right? So they raise marginal utility of consumption. So it's not surprising that the price of core inflation risk is negative. Because they're contractionary, they shrink not just output, but also for dividends, corporate dividends. So they're bad for stock returns. Hence, we have this negative relation between core inflation and stock returns. Bond returns, it's obvious. Foreign exchange, it's less obvious perhaps because we think that inflation raises kind of the nominal price level, and that makes my currency less valuable. But because it's contractionary, it raises the marginal utility of the domestic investor. It raises the stochastic discount factor, so the real exchange rate actually goes up. And we show that this real effect dominates the nominal effect, and so you also get this negative beta on foreign currency. And the only one that doesn't kind of unambiguously go in this negative direction is the commodity futures asset class, where kind of inflation effect is kind of ambiguous. On the one hand, the core output goes down, so it's kind of contractionary that pushes commodity prices down. On the other hand, of course, there's a nominal effect, if oil prices going up, including commodities. And in fact, this is one asset class where we get the beta of the core inflation beta to be 0, which suggests that this is what's driving it. Although there are some commodities behave differently from others, which we can discuss in the Q&A. And for energy, there is both kind of the price of risk and the betas are much more ambiguous because of this role of supply shocks and demand shocks. Basically, what happens is that both positive, as long as commodities and energy and core goods are relatively substitutable, both supply and demand shocks are positive ones are expansionary, so they're lower marginal utility of the investor, but they have different effect on energy price, right? Good supply shock lowers the energy price, and good demand shock raises the energy price. Depending on which of these shocks is more important, the price of energy risk can be either negative, that's the first term, or positive. So if the supply shock dominates, it's a negative price of risk because supply shocks kind of are bad in that they lower the amount of energy you can consume. And if it's a demand shocks are good. They're pro-cyclical and they raise the energy price. That the second part is positive. And I'm now really almost completely done. The point that I wanted to make with this is that the change in the beta from the 99 to 2000 has to do with energy becoming much more pro-cyclical in this half of the sample. And I'm going to conclude and thank you.